Most beginners do everything right. They research the options, they open the account, they pick a low-cost index fund, they make the first investment, and then they make one mistake that quietly undoes a significant portion of everything they just built. It is not a complicated mistake. It is not a rare one. It happens to the majority of people who start investing for the first time. And it has nothing to do with which fund they picked. Quick note before we start. This video is for educational purposes only and is not personalized financial advice. The mistake is selling when the market drops, panic selling, watching the account value fall, and making the decision to get out before it falls any further. It feels completely rational in the moment. Your money is going down. The news is alarming. Everyone around you seems to be doing the same thing. Getting out feels like protecting yourself. But here is what actually happens when you sell during a market drop. You lock in the loss permanently. A fall in account value is only a realized loss if you sell. Until you sell, it is just a number on a screen that will move again. And then you face a second problem. You are now out of the market and you have to decide when to get back in. Almost no one gets this timing right. Most people wait until they feel safe again, which is usually after the market has already recovered most of what it lost. So they sell low and buy back high, the exact opposite of what investing is supposed to do. The reason this happens so consistently to first-time investors comes down to one thing. They have never felt a market drop before. Experienced investors have a reference point. They have seen their account fall 15% and then recover. They have lived through the discomfort and come out the other side. That experience is genuinely valuable and it cannot be learned from a video. First-time investors have no such reference, so when the account drops, and it will drop, this is completely normal. The brain interprets it as danger. The instinct is to protect what is left. What makes it worse is that market drops almost always come with alarming news coverage. Headlines designed to generate anxiety. Social media full of people either panicking or confidently predicting further collapse. None of that coverage changes the underlying reality. A broad market index fund is hundreds of companies. It has survived every crash in recorded financial history. It has recovered every single time. But in the middle of the drop, that fact is extremely hard to hold on to emotionally. This is why starting small matters, as we covered in the last video. Experiencing your first market drop when the account is small builds the emotional muscle memory that protects you when the stakes are larger. The numbers behind panic selling are genuinely difficult to look at. Research from JP Morgan Asset Management has consistently shown that missing just the 10 best trading days in the market over a 20-year period reduces your overall return by roughly half compared to staying invested throughout. 10 days out of roughly 5,000 trading days over 20 years. And the timing makes it even more unforgiving. The majority of the best trading days happen within 2 weeks of the worst trading days. The sharp recovery almost always follows immediately after the sharpest drop. The investor who panics and sells during the crash is almost guaranteed to miss the recovery. They get the loss without the rebound. They get the worst of both outcomes. According to data from Dalbar, a financial research firm that tracks investor behavior, the average equity fund investor has consistently underperformed the market index by 3 to 4 percentage points per year over the long run. The primary reason identified across decades of data is poor timing decisions. Buying high and selling low in response to emotion rather than strategy. The market does not punish you for picking the wrong fund. It punishes you for leaving at the wrong time. 3 things that meaningfully reduce the chance of making this mistake. The first is understanding what you own. An index fund tracking a broad market is not one company that could go to zero. It is hundreds of companies across dozens of sectors in multiple countries. For the entire fund to go to zero, every single company inside it would have to fail simultaneously. That has never happened. The index has dropped significantly in crashes, 2001, 2008, 2020, and recovered every single time, going on to reach new highs. When you know this clearly, a 20% drop feels different. It still feels uncomfortable, but it does not feel like everything is gone. The second is reducing how often you check your account. Research consistently shows that the more frequently investors check their account value, the more likely they are to make reactive decisions. Daily checking correlates with lower long-term returns. Monthly or quarterly checking correlates with better outcomes. Set your investment up, contribute consistently, and check it quarterly at most. The daily number is noise. The 10-year trend is the signal. The third is automating your contributions. When investing is automatic, a fixed amount moving from your account to your investment on the same day every month without you touching it, it becomes invisible. You stop making active decisions about it. You stop watching it as closely. And the emotional trigger of seeing it fluctuate is significantly reduced. Automation is not just convenient. It is a behavioral protection against your own worst instincts in a downturn. So here's the simple version. The biggest mistake most beginners make is not a bad fund choice or a timing error. It is selling when the market drops and locking in a loss that time would have reversed. Understanding what you own, checking less frequently, and automating your contributions removes most of the emotional risk from the equation. The investors who build real wealth over time are almost never the ones who made the cleverest picks. They are the ones who stayed in when everyone else got out. This week, one action. Set up an automatic monthly contribution to your investment, whatever amount fits your budget. Remove the decision from your hands, let the system run.